Hello and welcome to the Market Share, your first source for market information. I'm Paul Gifford, Chief Investment Officer at First Source, and joining me today is Matt Noll, one of our senior portfolio managers. Matt, a lot of news about markets being volatile, but one of the other topics that has been volatile has been consumer confidence. So can you share some information about consumer confidence and how that's looked at?
Yeah. So when we look at consumer confidence, it's one of those surveys that really looks at how people feel about things. More so, if they're more confident with the markets, with economies, they're going to end up spending a little bit more, maybe on big ticket items like a car or a home. If they're less confident, they're going to spend a little bit less on those items. When we take a look at this chart that shows consumer confidence going back for the past 35 years or so, we've got a green line that shows incomes over $100,000 and a blue line that shows incomes under $100,000. What you end up seeing is typically people feel the same regardless of income over time. You may see higher incomes leading on the way up with spending, and then on the way down provide a little bit of buffer. But one of the things that really we're looking at here is how are people feeling about their finances, about the economy, and how is that going to kind of help markets with how they spend.
Is consumer confidence always a good indicator for markets?
It can vary. There are some other indicators that might go the opposite way. When we take a look at more hard data, which would be something like employment numbers, GDP numbers, you could see some differences. We have a chart here that shows consumer spending, so this would be considered hard data, where consumer confidence would be that softer data. Consumer spending over that same 35-year time period has continuously gone up and to the right. So even as you have the ebbs and flows of consumer confidence, the consumer still spends more and more over time.
So just because we feel bad doesn't mean we're stopping the checkbook per se. That's an important thing. One of the things when we think about coming into this spring is consumer confidence in their spending, but also their debt structure and how well they're structured. Can you talk a little bit about household debt?
Sure. So there's a couple things with household debt. We really saw a big change after COVID. A lot of households locked in lower interest rates, particularly on mortgages. Spending kind of increased a little bit as incomes went up. So the household debt situation has changed a lot in the past 10 years versus historically. We've got a chart here we can show. It shows debt service payments as a percentage of income. So how much are people spending to service those debt levels? You see a big drop off after 2020. Again, the pandemic, a lot of money coming into the system. The debt levels weren't as high, but when we look back to maybe 2008, 2009, you saw adjustable rate mortgages. Those reset higher, people had to spend more on that. So over the long term, we're kind of back to where historically we have been normally, so there's still some room for people to spend.
Which is great news as we've come into some of the volatility we've seen in markets. Matt, appreciate your comments on the consumer. Consumers make up about 70% of the spending in the United States, so that's an important part of what we look at in making investment decisions for you. If you enjoyed today's content, I encourage you to share that with friends and family. If you do not currently subscribe to the Market Share, you can do so using the QR code at the end of the video or emailing us at wealthadvisory@firstsource.com. And as always, thank you for the opportunity to serve you and your family, and have a great day.